One fund on point for today, the expert to talk about it. Welcome to the ETF of the Week. Yes, this is the ETF of the Week, where we examine trending, new, newsworthy, unique, and intriguing exchange-traded funds with Todd Rosenbluth. He's the head of research at VettaFi, and if you go to VettaFi.com, you will find all the tools you need to not only research the funds we talk about here, but to make yourself a better, savvier investor in ETFs. Todd Rosenbluth, it's great to chat with you again.
It's great to be back.
Your ETF of the week is
the Goldman Sachs Corporate Bond ETF, ticker GIGL.
GIGL, G-I-G-L, the Goldman Sachs Corporate Bond ETF. And, you know, people will hear Goldman Sachs, they'll think old line company, but this is not old line fund. This is a fairly new fund. So why this fund now?
You're right. So this is a year where we've seen asset managers bring some of their best ideas into the ETF space through active management, and fixed income ETFs has been a key area for that. And that's what Goldman Sachs has done. GIGL, or GIGL, we might as well say that out loud once in a while, is a great example of it. This is the best of Goldman from an active management standpoint, focused on an area of the marketplace that has been very popular. Corporate bond spreads have tightened this year. Earnings trends are quite strong. There's optimism. People are trying to figure out how they navigate the fixed income universe, and they can lean on a firm like Goldman Sachs to be able to help them out. And we'll talk about some of the benefits of it being actively managed. But we think this is a great fund to focus on, and we at VettaFi are going to be talking about it at an upcoming symposium on December 9th. Goldman Sachs is going to be one of our partners for that. Wanted to get the word out in advance.
Why particularly this fund? Because it's not like there aren't corporate bond funds and active corporate bond funds out there from established money management firms. So why this fund? And is this fund bringing over a great track record as a conversion, or as they made the change to become an ETF, did they tweak things up at all?
So no, this is a new ETF. This is not a conversion of an existing strategy. And you're right, there are some other actively managed corporate bond ETFs. This caught my eye because it launched this year, because it's Goldman Sachs that has been gaining market share as an active ETF provider. And to me, one of the benefits of an active approach with corporate bonds is you get a manager that helps to navigate the universe instead of an index-based approach that iShares or Vanguard or State Street has, which just replicates the index. This takes valuation into account, and there's also the flexibility for this fund to invest in some bonds that are below investment grade, that perhaps there's a chance for being upgraded, which is a key opportunity. So with index-based corporate bond ETFs, you tend to find that they own nothing but investment grade corporate bonds. But I like the fact that this fund has some flexibility, and you've got the experts at Goldman that are helping to sort through that universe.
There are two things that have to come up anytime we're going to talk about an actively managed bond fund. And one is expense ratio, because although we know that expenses do not necessarily make the difference, there's always that, is it worth it to pay for active management? This fund out of the box has a pretty good expense ratio, right?
That's right. So 29 basis points is the expense ratio. So Goldman is bringing its scale to help support the overall fund. We tend to find that active management, you're paying a premium, but more and more we're seeing asset managers bring their best ideas into the ETF space without that hefty premium. Sometimes that's happening, but not all the time. And I like that with this fund. So if you're choosing between this and an index-based product from iShares, from State Street, from Vanguard that we talked about, you're not paying that much of a premium.
And then I said two things. The other, of course, would be yield. And this fund is fairly new, but what are you looking at in terms of yield? Because any bond fund, that's a concern.
Right. So the yield, as I last looked, is 4.4%. That's the 30-day SEC yield. That's as of October. We're recording this on the 1st of December. And so we don't yet have the latest information. But that's a competitive yield. I think that's appealing. Obviously, we're in an environment where the Fed has cut interest rates multiple times in recent months, so the yields are coming down overall. And there's been a lot of demand for investment grade corporate bonds, so the yields for those bonds have come down. But I think for almost 4.5% is pretty compelling in this environment. Then that of course I believe is net of the fees. So you get the first part of your question earlier impacts the second part of it. So if the fee was considerably higher, that yield might be lower as a result.
When it comes to corporate bonds, again, most of this portfolio, from what I've looked into it quickly, is investment grade stuff, et cetera. So how much do you want to make an allocation here if you've already got something and if you've tilted towards high yield in the past? Because I think there are plenty of people who have bond funds and they add high yield, but they don't necessarily add corporates.
Right. So to me, the appeal or one of the use cases for GIGL is that you could have core bond exposure through the aggregate bond index, whether that's an iShares or Vanguard or State Street index-based product, and you could overweight your exposure to corporate bonds. So as I look at the ag right now, it is heavily weighted towards treasuries. It's nearly half of the portfolio. And then mortgages and agency bonds are a significant chunk as well. So if you had confidence in the earnings trajectory for 2026 and you believed in the financial health of the companies that were likely to be found inside a corporate bond ETF, you'd want to overweight that sector. And this is a way of doing that with the benefits of an active manager. You did mention it's mostly investment grade. There is some high yield exposure. Yeah, people will often use a high yield bond ETF that's dedicated to high yield bonds instead of having the management have discretion to add a little bit of high yield exposure based on those opportunities. So this is going to be a safer, more stable alternative to a high yield bond ETF, but have the benefits of flexibility to own a small slice of that, which I think is more common in the active corporate bond space. It certainly is not common in the index-based world. A bond will actually get removed from the index when it falls below investment grade, and those indices wouldn't consider a bond that already started at below investment grade.
I also noticed when I looked at this fund that it has about 20% of its portfolio still in government bonds. And not that that's a bad thing, but given that it's an actively managed fund and that it's a new fund, do you expect that may winnow down a little bit as they get a little longer in the tooth, a little more experience running this fund, and maybe find more things that they want to put their money into?
So there's probably twofold on this, and since I'm not managing the fund, I don't know all of the insights to it. When a fund is relatively new and growing, it won't put all of its money to work out of the gate. So as new money comes in, they can put that to work. There's also, with the benefits of active management, you can move into cash. So I imagine what is a good chunk of what that is there's money sitting in cash or cash equivalent to get exposure, to stay invested in bonds, but in basically cash equivalents. So that's the benefits of an active approach, is that you can use the expertise of the management team at Goldman Sachs to help you decide how much exposure to corporate bonds and whether or not to take on more or less risk. So I expect as this fund continues to age and grow in size, that we probably will see a lower amount to it. But again, they'll have the flexibility. That's a positive to me.
When you take a look at a fund like this, is this bedrock because you want to be able to have a sleeve of your portfolio in something like corporate bonds? So you're buying this and saying, I'm going to be committed to this kind of an asset class forever? Or is this a play for now that you might get out of when we see the rate environment change, et cetera?
Yeah, so I think this is a tactical opportunity. If you believe that corporate bonds are going to do well in 2026, and at least the start of 2026, and you want to have an overweighted exposure, I'm making the assumption that people have exposure to a broadly diversified index-based or actively managed fixed income strategy. Again, whether it's the ag or it's a mutual fund that's actively managed, relative to the ag, and that this is a subset. So this is to overweight corporate bonds. If we get an environment where recession is a concern, that people are looking to a flight to safety, a triple B rated, primarily corporate bond ETF is not as safe a haven. So I think this is a risk on way of investing into fixed income without taking on high yield exposure. People might want to pull that back over time, or if the environment shifts as a result. So let's be tactical with ETFs when we can.
But the tactic now, lean in. It's GIGL, GIGL, the Goldman Sachs corporate bond ETF, the ETF of the week from Todd Rosenbluth at VettaFi. Todd, great stuff. We'll talk to you again next week.
Thanks a lot, Chuck.
The ETF of the week is a joint production of VettaFi and MoneyLife with Chuck Jaffe. And yes, I'm Chuck Jaffe, and I'd love it if you check out my hour-long weekday show by going to MoneyLifeShow.com, or you can search for it wherever you find your favorite podcasts. Now, if you're searching for information on your favorite ETFs, or maybe something like GIGL, which could be your next favorite ETF, check out VettaFi.com, where they've got a full suite of tools that will help you out with information on the funds you're looking for. By the way, they're on Twitter or X at Vetta_5. Todd Rosenbluth, their head of research, my guest, he's on X as well at Todd Rosenbluth. The ETF of the week is here for you every Thursday. Make sure you don't miss an episode by following along on your favorite podcast app. And we'll be back with another ETF for you to consider next week. Until then, happy investing, everybody.